If you often blame the market after breaking your own rules, this video is for you. It's a feeling many traders know all too well. The sting of a loss, followed by a quick, almost automatic reaction. It was the news, or the market is just manipulated. You close the trade, maybe slam the laptop shut, and try to forget. But forgetting doesn't lead to growth. Let's talk about why this happens and what to do about it. Imagine a trader named Leo. He's been trading for a while now. Smart and dedicated. He spends hours researching, has a detailed trading plan, and a set of rules he promised himself he would follow. But today, things went wrong. He saw a setup that looked almost perfect, but it didn't quite meet all his criteria. A little voice in his head said, "This is the one. Don't miss it." So he jumped in, bending his rules just this once. He used a bit more leverage than he should have, convinced this trade would make up for last week's small losses. At first, it looked good. The price moved in his favor, and he felt a rush of validation. But then, the market turned, swiftly and without warning. His small gain vanished, and now he was deep in the red. Panic set in. He held on, hoping for a reversal, but it only got worse. Finally, he couldn't take it anymore and closed the position for a significant loss. The first thought that flashed through his mind wasn't, "I broke my rules." It was, "This is ridiculous. The market is completely irrational today." He opened his phone and started scrolling through financial news, looking for a headline, an event, anything to explain the sudden move. He blamed a surprise announcement, his broker's execution speed, even invisible whales manipulating the price. Anything but his own decision to enter a trade that didn't fit his plan. This is a classic defense mechanism. Leo, like many of us, is trying to protect himself from the emotional pain of being wrong. Admitting I made a mistake feels like a direct hit to our ego, our sense of competence. It's much easier to externalize the blame. The market is a faceless, powerful entity. Blaming it feels safe because it can't argue back. It shifts the responsibility from "I am not a good trader" to "the game is rigged." This instantly reduces the psychological burden. Responsibility feels threatening because it means we are accountable for the outcome. If our actions led to the loss, it implies a flaw in our judgment or discipline, which can be hard to swallow. The next day, Leo is back at his desk. He's still frustrated, but he's determined to win back his losses. What does he do? Does he review yesterday's trade to understand why he broke his rules? No. Instead, he starts searching online for a new indicator. He finds one that promises to predict market turns with incredible accuracy. He spends hours adding it to his charts, tweaking the settings, and backtesting it. He believes the problem wasn't his behavior, it was his tools. He just needed a better system, a holy grail that would finally make him profitable. He's looking for a technical solution to a psychological problem. This cycle is incredibly common. A trader loses, blames an external factor, and then seeks a new strategy or indicator, believing it will prevent future losses. But the underlying issue, the impulsive decision-making, the rule-breaking, the emotional trading remains untouched. It's like trying to fix a leaky pipe by repainting the water-stained wall. You're addressing the symptom, not the cause. Let's look at Leo's trading journal. It's neatly organized. He tracks his entry and exit points, his profit and loss for every trade. On the surface, it looks professional, but what's missing? There are no notes about his emotional state. There's no column where he logs. Whether he followed his plan, he doesn't write down, felt impatient and entered early, or broke my stop-loss rule because of hope. His journal tracks the market's movement and his account balance, but it completely ignores the most critical variable in his trading: himself. Without tracking his own behavior, he is blind to his patterns. He repeats the same mistakes over and over because, from his perspective, each loss is a unique, external event, not part of a self-sabotaging habit. Improvement becomes impossible because he's not even aware of what needs to be fixed. So, how do professional traders break this cycle? It's not about finding a perfect strategy. It's about building an unbreakable commitment to They shift their focus from blaming the market to owning their actions. The first step is meticulous tracking, but not just of profits and losses. A professional trader's journal is a mirror to their mind. They track every single rule violation. Did I enter too early? Did I move my stop loss? Did I revenge trade after a loss? They asin a grade 2 each trade. Not based on whether it made money, but on how well they executed their plan. A losing trade where they followed every rule is considered a good trade. A winning trade where they got lucky after breaking a rule is a bad trade. A warning sign. Next, they schedule regular reviews of their emotional decisions. They ask themselves the tough questions. Why did I feel the need to take that trade? Was I bored, greedy, or fearful? By naming the emotion, they take away its power. They start to see their emotional triggers and can develop strategies to manage them, whether it's stepping away from the screen or reducing their position size. They measure their behavioral consistency. Their goal isn't just to be profitable, it's to be disciplined. They know that profitability is a byproduct of consistent, disciplined execution. They might track what percentage of their trades in a week were executed flawlessly according to their plan. Their primary metric for success becomes their own behavior, not their P&L. This is the fundamental shift. Amateur traders believe a new indicator or strategy will fix their problems. Professional traders understand that no tool can fix a flawed mindset. No indicator can stop you from acting on impulse. No strategy can force you to be patient. These are internal skills that must be cultivated through deliberate practice and radical self-honesty. Leo's problem was never his chart, his broker, or the news. It was his refusal to look in the mirror. The moment he stops searching for external solutions and starts taking ownership of his internal world is the moment his trading journey can truly begin. He has to accept that he cannot control the market's random movements, but he can control his response to them. The path to consistent trading isn't about finding the perfect map of the market. It's about developing the self-discipline to follow your own map, especially when the journey gets difficult. It's about accepting that you are the single greatest factor in your success or failure. The market will always be the market. It will be volatile, unpredictable, and often irrational. But your behavior doesn't have to be. Here's the one clear takeaway I want you to leave with today. You cannot fix the market. You can fix your behavior. If you want to build accountability and discipline in your own trading, follow Mindful Trader Lab. Thanks for watching.